Okay, so this is the financial focus part of the weekly webinar. If you haven't already, hit the subscribe, like, and notification buttons so that you're always notified of the of new videos that we have. We have new videos almost every week, a full weekly webinar, and then the financial focus. And then the financial focus for today is important year-end planning tips. So as I'm sitting here today, it's September 11th, and many of it's still summertime, and many of you might be saying, well, why are we talking about year-end planning so early still when we're in the summertime? Well, because it's never too early to start this. You want to be ahead of the curve. There may be things that maybe you get tied up in at the end of the year, or you just want to be ahead of the game, and that's good. We do it because we've got several people we have to take care of, but it gives you more time to make adjustments and make changes to your plan, and take these steps that you may want to take. So I took an interesting approach. I shared on the weekly webinar that we have a new member of the team, somebody we've been working with for over a decade now, but he's officially part of the team. Sasha Afanasiev, his name is a CPA, one of the smartest individuals I know. And of course, Emily, you all know Emily if you're your client. So I was preparing this webinar yesterday, and I sent an email to both of them, and I said, give me some tips, give me some year-end planning tips. And I told them what we were talking about on today's webinar, because there's a document we send out to clients every year, and I'll just share that with you. Let me start here. So we send this document electronically, and if we need to for most, but it's a year-end review, and we ask simple questions. We ask, of course, the name, but we ask for tax events. Please list any other tax events or changes for the year. Example include sale of home, consulting income, tax credit, changes in employment status, etc. Please list any major expenses to your changes to your expenses in the past year. And then tax prep, we want the name of the CPA. So we send this out to gather this information because we know what to look for. If we have this information, then hey, we can start making these year-end adjustments. But so I said to Emily and Sasha, I said, well, give me kind of your top three. And I'll just share with you here what Emily said. So I think Emily's listening. Let me see. Emily said, confirm retirement plan / IRA contributions. She says, I'm here. Confirm retirement plan / IRA contributions are on track to max or hit the amount they intended. That's a great one, because you may have, maybe you got a raise and you're able to put more money into your retirement plan or put more money away, but maybe you think that your employer is maxing out your plan, but they may not be. And if you hit December 31st and your goal was to put $30,500, if you're over 50, into your hopefully Roth 401k, if that makes sense for you, then and you realize, well, heck, I missed that by $500. Well, it's too late. So do the math and make sure you're on track to hit to make those contributions. So really, really good point. Let's check that off. Make sure you've taken advantage of any tax planning strategies like tax loss harvesting and Roth conversions. So let's take those one at a time. And Sasha talks about tax loss harvesting too. So tax loss harvesting is when you have losses in investment accounts, so non-IRAs, non-Roth accounts, of course, non-retirement accounts, your work retirement accounts. I'm talking in your taxable bucket. And let's say you bought XYZ stock and it fell. Well, you can sell that position, what we call realize the loss, and offset it against any future gains. And also offset it against any income that you have if you don't have gains to offset. So that is a really good strategy, and one that you should look at for sure. Now there's rules around it. If you want to still own that stock, you can sell it, and you can buy it 31 days later. There is this wash sale rule that we have to follow. You can't sell it on Monday, buy it on Tuesday, realize the loss. There are rules around that. But tax loss harvesting is very, very important. Roth conversions, folks, this is what we work on from now until the end of the year, or Roth conversions for folks. We do it as much as we can throughout the year, but this is Roth conversion time. It's not pumpkin spice time for us. It's Roth conversion time. But Roth conversions are a very, very important part of a good tax efficient strategy, and it's different for everybody. Of course, remember, if you didn't hear hear it on the webinar, I'm going to say it again. Anything that you hear today is on any of my videos are about education, not advice. So any advice should be specialized, tailored advice just for you, and you should get that directly from a qualified financial planner. But from an education point of view, a Roth conversion is one of the best tools we have under the tax code. It's really one of the most liberal steps that we can take because it allows us to decide the tax rate that we're going to pay on our retirement account for your lifetime and for 10 years. So what I'm referring to is if you convert funds at, say, 20%, you move them from your traditional IRA to a Roth IRA, and let's say your tax rate on that conversion, for example, is 20%. Well, that's the tax you're going to pay for that money on that money for the rest of your life. So if taxes go up even 1%, you've saved yourself some money. Well, we think taxes are going to be much higher in the future. So, if they go up 50% or maybe even 100%, and instead of paying 40% on the withdrawals out of that account, you're paying 20%. My gosh, that was a good deal. And then if you happen to pass that money on to your heirs, well, then they, under the current rules, if it's a Roth, they don't have to withdraw that money until the 10th year after the year you pass away. So truly, you're locking in your tax rate for the remainder of your lifetime plus 10 years. Roth conversions are huge, and there's really no restrictions. You can convert $100 or you can convert $1 billion. It doesn't matter. The IRS, there's no speed limits on that. The IRS says the one requirement we have, or the tax code says, the one requirement we have is that you pay the tax when you do the Roth conversion. Pretty simple, and you do the math to figure out what tax rates works for you. So now we're looking at, Emily says, review yearly account performance and make sure your investment allocations still align with your current goals and timelines. Really great point. And that comes back to review your financial plan every single year. And this is a really good time to do that. And it's a good time to review those investments, how they performed, if they're positive, negative, what the reason might be for that, and if they still align with your current goals and timelines. So this is important. So Emily is a fantastic financial planner, and she included something that is vitally important and isn't talked about enough in the financial planning process. So most financial planners, they don't even get into this. They talk about your current goals, needs and objectives, and risk tolerances, right? So that's typically what we see. And of course, you always want to make sure that your investments are in line with your risk tolerance. But your risk tolerance generally is driven by when you're going to need your funds. So what Emily's talking about with timelines is what we call account segmentation, and that is setting up your investments so the funds are available and on the timeline that you're going to need it. So if you need funds in the next 3 years, for example, well, you don't want to take any or very little market risk of those funds. You can invest more aggressively as you go out on the timeline, but those things have to be adjusted on a regular basis. So right now, as we're nearing the end of the year, is a really great time to check in, and I'm very, very happy to see that Emily added that on that number 3. All right. So moving on to, nice job, Em. So moving on to Sasha. Sasha wrote, well, don't forget RMDs. Speaking of RMDs, given most people do not, okay, so before I move on from that, don't forget RMDs. So required minimum distributions. If you've reached age 73 this year, you've triggered required minimum distribution age. Now, you technically don't have to take the distribution until your required beginning date, which is April 1st of the year following the year you turn 73. In this example, that would be April 1st of 2025. But most people like to take that first year distribution before the end of the calendar year. Technically, you don't have to take that distribution until December 31st. If past that first year. So technically, the first year, you don't have to take it until April 1st. Every subsequent year, you have to take it by December 31st. I wouldn't wait until December 31st because, boy, you're counting on somebody, in the weekly webinar section, we talked about a custodian who told somebody on the phone, hey, you can't do something, and they could do it. It had to do with a 60-day rollover. Well, you don't want to count on those same people who don't necessarily know the rules, know what they're talking about sometimes, to make sure you get your distribution done. Do it well ahead of time and make sure you get your confirmation. So the current age for required minimum distribution is age 73. And Sasha goes on to write, speaking of RMDs, given most people do not itemize anymore, that is, the standard deduction is high enough. So yesterday in class, we have a group of folks who are retired or very nearing retirement. And we started talking about tax deductions. And I said, raise your hand if you're only taking the standard deduction. Almost everybody's hand went up in the class. So what that tells you is that they don't have deductions that are more than your standard deduction. So Sasha says, given that most people do not itemize anymore and take advantage of charitable deductions, qualified charitable distributions are a great way to do both, satisfy an RMD and get a tax benefit for a charitable contribution. So, and of course he said, note the specific rules to make a QCD. So the QCD, or qualified charitable distribution, is something that has really gained a lot of popularity. So it allows you to take, each individual can take $105,000 a year out of their own individual IRAs and send that money directly to a charity. It doesn't have to be 105. It can be less than that. That's the max today. It used to be 100, and it just got started stepping up for inflation. So it's $105,000. You can give directly to a charity. It has to go directly to charity. Can't hit your checkbook first. It's got to go directly to a qualified charity. And there are rules around qualified charity, and that can satisfy your RMD. It also is a great way to take money out of your IRA if you're charitably inclined, because you don't pay tax on that money. So it's a good way to start emptying your IRA for tax-free. So good point on QCDs. So don't forget RMDs. Talked about QCDs. And of course, Sasha said, don't forget to harvest losses to offset any gains. And we talked about that. So if Emily mentioned it too. So if you sell positions that are down, so they have losses, and you have other positions that have gains, well, if you got $1,000 loss and $1,000 gain, and you sell both positions, well, now you offset the other one for the other. So that's a simple example. It gets a little bit more complicated than that. Remember, there are rules around it. I mentioned a wash sale rule, but that's something to pay attention to. And he said, bonus tip, which is right up your alley, is of course exploring conversion strategy potential if you have a low income year. So I kept this in here because this is something that people miss. I was speaking to a woman. It's been a few weeks now, and I talked about this on my webinar with David McKnight. And there's David and I kind of did back-to-back webinars. They weren't really back-to-back, but they were pretty close. So they're out there on YouTube for you to look at. But I talked about this woman who called in, and she found us through the Slott group. And she called in, and she was explaining her situation. And she said, I've got a financial advisor. I have a CPA, and I've been asking them about Roth conversions for many years. And I don't know if they don't really understand it. I don't know if they see the benefit. But they had a lot of, first of all, they're high income earners, but they had a lot of real estate investment. And for the previous 2 or 3 years, they showed zero income, zero tax liability, because they had big deductions on their real estate properties and other items. Now, they had a great opportunity to convert a significant amount of money during those years because they had very little income, or no income, no taxable income. So if you have pockets of time like that, well, it's a great opportunity to convert those funds, because then for a married couple, you can convert, $380 thousand this year to the top of the 24% bracket. So take advantage of those low income years for sure. Review these things every year, but certainly at the end of the year. And then Sasha came back and he said, well, I actually have this document, and there's other things you might want to consider in there. And so I'm just going to list them here. He said he talked about life changes, discuss major changes in your life, such as marriages or divorce, births, deaths in the family, job or employment changes, starting a business and significant expenditures, real estate purchases, college tuition payments, etc. All those things happen to people as we go along. So I could pick out many. I could pick out one right on the end for myself. My daughter just started I dropped her off at Penn State a few weeks ago. My youngest daughter, it was a terrible day for me, exciting day for her, but dropped her off at Penn State. So we've got these college tuition payments that are higher than they were, when she was at the local community college while in high school over the past few years. We've got 2 client deaths that we're working through right now. That changes their tax situation going into next year after the end of the calendar year. So these things happen. Really good time to look at these is at the end of the year. We talked about capital gains and losses. Let me check these off. Sasha writes, also consider selling portfolio investments that are underperforming before the end of the year. Net capital losses can offset $3,000 of the current year's ordinary income. So I shared with you on capital gains and losses how a capital loss can offset a capital gain. But if you don't have gains that you're going to take for that year and you have a loss of $3,000, that $3,000 is allowed to offset income. So it reduces your income. I once had a person I knew who invested in a business and she lost about $50,000 in this business. So bad situation. And she said that, it's really a shame that money's just kind of dead. I said, well, you can take a deduction on your taxes at $3,000 a year from, until that whole $50,000 is drawn down. And she was very happy about that. It just kind of gave her some sense of, okay, maybe it's not all lost, right? Because she could offset the income. Estate and gift tax planning. Let's make sure you're appropriately planning for estate and gift tax purposes. There is an annual exclusion for gifts to help save on potential future estate taxes. Review lifetime gift and generation skipping tax transfer opportunities to use additional exclusion and exemption amounts. So really important as well. We know that the exclusion amounts for federal estate tax is very, very high today. That probably will adjust back at some time or come down at some time. That's the general thinking. But we're in Pennsylvania. In Pennsylvania, we have an inheritance tax. That's no joke. That's on $1. So not for spouses, but direct lineal descendants. They have to pay a certain amount, and then if people above that, it's a higher amount, or people away from that direct lineal, it's a higher amount. And if it's just someone who's not related to you at all, it's even a higher amount. So there are things to pay attention to when it comes to estate planning, even if you fall under the exclusion for federal estate tax. State and local taxes, remote working arrangements, or moving your residency could potentially have tax implications to consider, for sure. Education planning, save for education with Section 529 plans, potentially for you. There can be income tax benefits to do so, and there have been changes with the way these funds can be used. Update to financial records. Determine whether any updates are needed to your insurance policies or beneficiary designations. So, hey, listen, you hear us talk about that all the time. Update your, review your plan every year. Not a bad time to do it. At the end of the year, when you're looking at these other things, just take a look at those beneficiary designations with life insurance policies, annuities, IRAs, and 401ks for sure. And even your taxable accounts, your brokerage account, your investment accounts, your bank accounts, they can have either a POD, payable on death, or a transfer on death designation. It's a good time to check in and take a look at things. Estimated tax payments. With underpayment interest rates being significant, let's review withholding and estimated tax payments and assess any liquidity needs. So, we've got estimated taxes due next week, the 16th, and they've got to be paid, right? So if you have to make estimated payments, if you don't do withholding and you have to make estimated payments, then you should know when those are and plan appropriately. So we've got another one next week, and then another after the end of the year. So all good information. Your big takeaway for this should be get on it early, folks. So I know it's September 11th. I know it's still early. You're saying, well, geez, it's still nice outside. I still like to go to the shore maybe once or twice more, or get in the pool before I close it up. I'm pretty sure if you're in this area, you've already closed your pool. But it is not a bad thing to get ahead of this because, first of all, we get busier towards the end of the year. Life events can happen. Health events can happen. Just take a look at that year-end planning. If you're a client of ours, you're going to get that year-end planning document where we ask you questions. These are some of the things, what I shared with you today, are some of the things that we're filtering through. Okay, well, Mr. Jones, we received your year-end planning document. Now, these are the things that we're filtering through to see what we need to do for you. So I hope that was helpful. I hope that gave you some insight and some action items. If you have any questions, you can reach out to us at, that's not the one. If you have any questions, you can reach out to us at questions@attleboroughwealth.com. That's questions@attleboroughwealth.com. You can always visit our website at attleboroughwealth.com to learn more about us. And you can also schedule time using that at the website. There's a contact us button. There is also a web link in the description of this video if you want to schedule a 15-minute discovery call with me to talk about anything that we talked about today or any other videos. I'm happy to do that. Or if you can't find time on that calendar, that digital calendar, you can reach us at questions@attleboroughwealth.com. Folks, it's always great to see you. I really enjoy doing these webinars. I hope you enjoy the content, and I look forward to seeing you again soon. Take care.